Welcome everybody to the month of May. This is your monthly market update with myself, Jacob, Nick King, and Pablo Marul. It's been a tough start to the year. It's been a rough month, but before we get into that, we want to just hopefully get your interaction with this video. If you can subscribe to the channel, give us a like. Thank you for your support there. What we want to spend time with, no more than 10 minutes, talk about what we've done to address the current market volatility, presently where we're at, what we're seeing, and then I think what a lot of people want to probably get an understanding is where we're going here. So before we get into it, gentlemen, welcome. How are you guys doing this month of May?
Very good. Thank you for asking, Jacob.
Doing great, Jacob. Managing the risk of these turbulent markets here. A lot to address today.
Let's jump into it. The thing in which I first want to communicate to everyone is what we've done in the lead up to this. No doubt has it been a difficult month, difficult year so far. We haven't had a lot of room to find safety. A lot of these asset classes that are inverse to the stock market haven't behaved as they should. There really hasn't been anything that has distinguished itself to find room for comfort and gains as the stock market sells off. The good news is that we're starting to see that. So two quick things that I want to share that we've done and that we have prospered with. There's two things. One being with the fixed income side of things, the bonds, opposed to buying bonds that have a longer duration. We knew that those were going to be impacted more with the Fed raising rates. Not too technical here. We decided to buy short-term duration bonds that were going to be less volatile. So that has been very favorable so far. And on the equity side, what we've done is we've also at the start of the year favored more value dividend paying companies with better cash flow in comparison to what has propelled the markets the past couple of years with tech stocks, growth stocks. That again has paid big dividends here. So anything else to add there?
Certainly. I think you touched on it perfectly in terms of how much the market's shifting, and we'll dive into kind of the pulse of the market, the styles, value versus growth, and what makes sense right now. Because there's a lot of confusion, a lot of talking heads, especially if you turn on CNBC, you'll hear different viewpoints that will drive you mad. Take a step back, just look at a very good objective approach of this and make it crystal clear.
As much as we can, right? We're definitely, no one holds a crystal ball, but there are a lot of things in our control, and we've maximized those things with your accounts here. So, Nick, what can you tell us about presently where we stand and some of the things that we're keeping an eye on?
Yeah, certainly. So 2020 came with a lot of growth stocks that were favorable. And when we look at business cycles, we're seeing a compression in terms of the size of business cycles. So what I mean by that is typically from a recession to recovery, it's 8 years within the US on average. But now we're at the tail end, we believe, of the business cycle. And typically what you see outperform is value stocks. So think companies with a lot of dividends outperform growth. And that makes sense right now. And you're going to see a lot of companies start to get very lean in terms of how they operate. And that's going to unfortunately go into employment. We already saw Netflix, for example, just laid off a large amount of employees. And so the real fear that we have on the table right now is stagflation. And that's inflation with bad unemployment numbers. Simplistic way to look at it is easy money is gone. And easy money was the Fed printing a lot in 2020 after COVID crisis, February 2020, but we don't have that anymore. In fact, it's the opposite. And so that's why cash heavy companies are going to do much better, because companies that don't have a lot of cash that need to borrow more, well, those lending costs are going to go up. And that's why typically value is cash heavy companies are going to do better than growth at this point. Those are the risks ahead in terms of how much are those rates going to go up? How well do companies navigate that rising interest rate? Pablo will talk about the risk additional risks ahead in terms of what we're forecasting.
One quick question for you here is, we don't want to be too forward looking, but you talked about these cycles, these economic cycles, these business cycles. And can you expand on currently right now, the message here we're trying to convey and the actions we took is favoring more value oriented companies that haven't done well the past couple of years in comparison to growth companies. When we come out of this funk, if we are in a recession or not, just briefly touch on, the turnaround, right? Because everything is cyclical. Is there a growth trade per se down the road? And if so, maybe when?
Yeah, great question. Towards the tail end of a business cycle, you start to see commodity prices go up, and we're certainly seeing that right now. But the target we have in terms of when we see this ending and the beginning of a new phase of the business cycle would be when the Fed funds rate gets to around the 2-year Treasury rate. Historically, that's been 100% accurate in terms of when the Fed will stop increasing the Fed funds rate. So a very important target that we're looking at.
The thing in which that I think is important for everyone to take away, at least one of the things, is we are doing the work to make sure, by no means are we timing the market, but we're very observant to find these windows of times, because these value-oriented companies are more favorable, dramatically more favorable than others for the year. But that is not a perpetual thing. And at some point in time, as the market sells off, these growth companies that are getting completely knocked off the table, they start to become attractive and they start to become inexpensive. And that's when you see this shift. So I just want to communicate that, because we're on top of that. The value trade has really done great things for us this year, but that isn't a long-term solution. And we're on top of the many things that Nick just said to catch that potential window of time to then get into those positions to hopefully have a very favorable return. So Pablo, what can you tell us about future outlook and other information that we're looking at?
Well, Nick mentioned this discussion that we are seeing on TV or we are reading, soft landing, hard landing. Soft landing will be we're going to grow less at a positive rate, but less than before. Hard landing is a recession. Probably the economy is going to slow down, decline in terms of economic growth. So what I am showing here, there is a graph of 2000. This is the .com. So if you can see, that was a case with recession, and the market, if you see in the first part, declined 29%. And why I brought this? Because I want to compare a case that was recession and you have a crash. Technically, the stock market fall more than 20%, and a case like in 2011 where was a soft landing. People started to get scared, but about a potential recession, but that didn't happen. And that is the second graph, that the market fell down 21% from the peak to the trough, but then it started to go up, and then it kind of recuperate in 9 months. So the question is, are we in a recession or in a hard landing or soft landing? So it's hard to know the most recent data regarding inflation. Inflation is coming out for June, from the next release. It's going to come lower than the previous month. So that's positive, because how we end up in this situation today is because we are coming with a lot of inflation. But now what happened with growth? The economy is growing. Well, the economy in the past quarter declined, but in this quarter is supposed to grow by 2.5%, which is good, because that will kind of confirm, if this continue, that maybe we're in a situation where we can avoid a recession. But in the future, we will see in the next 2-3 months how the economy is evolving.
And there's a lot of moving pieces to this, economics versus stock valuations. And they're all things in which obviously we look at to see where we stand ultimately with the stock market, so that we can make hopefully the best decisions for you all when it comes to your accounts. So as a quick last minute message here, if you look back at our market updates, stemming all the way from January, we were not very favorable of the market outlook for the first half of the year. And it's hard to believe, already being in late May, that's played out to be true. So one of the things that we're looking at to see is, well, where is this potential bottom? And the good news is that we're close. We might be in this turbulent time for maybe a few other months, and come hopefully end of summer, maybe early fall, we hopefully see that. The best thing to do if you have any type of concerns or worries, as I've done, is just give us a call. Make sure that you do not get caught up in what the stock market, the headlines are doing. And I emphasize this a ton because it really is about making sure that you have an understanding and direction which gives you confidence and comfort. Regardless of what the outlook may be, we cannot control what the markets are doing, but we can control what our plan is. And that's where I encourage everyone to give us a call, even if it's a short-minute call, just to get a little bit of the nerves settled by just talking things through. Please don't forget that we're here for you. And please don't forget that all the stock market investment world is just a vessel that we use to get to where we want to. And that's where we want to make sure we emphasize right now that, yes, these hard times are here, but we accounted for these hard times in your plan. So not a great time, not a fun time, but know that it is part of the plan, and we'll get through this as many times the markets sell off. Last note here, as I mentioned to many clients, is these are opportunities as well. These are opportunities for those that have potential new money to put into play. We love to buy things at a discount and things on clearance. This is the environment we're in right now. Typically, we get bear markets 3, maybe 4 times every 10 years. So take advantage of that. Talk to us to understand how you can benefit. Nick, Pablo, thank you for coming on. Is there anything else here that you'd like to add?
To tune out the noise in terms of what you're maybe reading or hearing, a lot of times that can lead it into a rash decision in terms of what you do with the money that you've worked so hard to save up. So if there is any of that uncertainty, certainly give us a call. I'll reiterate that, Jacob, but well said.
Thank you, gentlemen. And more importantly, thank you for everyone for watching and being a part of Zenith. We look forward to catching you next month with an update on where we currently stand. Take care.
Thank you.